Doing this paper of 9706, Feb
Yeah.
March 2024, paper 42.
Hmm.
Okay, this sum is related to standard costing. Source B is standard costing and source A was investment appraisal.
Yeah.
This is a normal combination where standard costing investment appraisal comes together.
Okay.
TC and budgetary comes together. In very rare scenario, you get budgetary and standard together.
Okay.
Okay, so read the question, please.
Yeah.
First,
SPL.
what am I supposed to calculate?
Miss, this is the B part. A part is upper.
We are doing the B part only. A part is already done.
Oh, okay.
Okay, so, okay. Sorry, the A part is not done. So read the question. What are they asking us to calculate?
They are asking us to calculate, prepare for January 2024 in a column format.
Hmm.
You're supposed to the fixed budget and the flexible budget.
Okay. So you're supposed to prepare in column format, fixed
Yeah.
budget and flexible budget. So because it is column, I will prepare the column.
Yeah.
What is fixed budget?
So fixed budget is like it's the master budget. It's basically the standard rate into standard quantity.
And what is flexible budget?
Flexible budget is the standard rate into actual quantity.
How do you prepare the budget?
How do you prepare? As in, you take the standard rate, then you multiply it by the actual quantity which is
So
given
what
over
what
there.
comes in the budget?
Oh, like that. So sales will come, revenue will come,
Yeah.
direct material, direct labor, overheads if there are any, and then profit.
Okay. Sales, direct material, direct labor, uh, overheads and profit. Okay,
Yeah.
fine. Read. Question now.
S Plc operates a system of standard costing. It provided the following budgeted data for January 2024. Production and sales 8,000 units with a selling price of $68 per unit.
Which
Three.
data is this?
This is the standard data.
Standard. So I'll read and I can start.
Yeah.
8,000 into 68.
Yeah, 544,000.
Hmm.
Then there's direct material, 3 kilos per unit costing 4 per kilo. So 3 into 4,
Into.
8,000,
Hmm.
which will give 96,000.
Hmm. Okay, I'll give you time to do the working.
Yeah.
What for direct labor? 4
Yeah.
hours.
4 hours paid at 6. So 4 into 6 into 8,000.
Okay.
Okay. And then for fixed overheads, 2.5 per direct labor hour. So
Okay. What
per
is
di
2.5?
6.5 is the charge that, sorry, 2.50 per direct labor hour.
So what is a direct labor hour?
6 na?
Hmm.
6 na? 6 is the direct labor.
Okay. No, direct
Yeah.
labor hours is how much?
Oh, sorry, 4 hours.
4 hours per unit.
Yeah, so 2.50 into 4 into
Why
8,000.
2.5? Okay, 4 per unit into 8,000
Yeah,
into 2.50. So this will give you what?
this will give 80,000.
Oh my god, 80,000. Let me check.
Yeah, it's 80,000.
4 into 8,000 into 2.5, 80,000. Okay. So what
Yeah,
is the profit?
1 minute, miss, I can't do so fast.
So from 544,000, if I'm going to subtract all this,
176,000.
okay. Flex budget is for how many units?
Flex budget is the actual quantity. So, is it given the actual quantity? 1 minute, let me see. Yeah, 7,000 units were sold. So, flex budget is standard rate into actual quantity. So,
Hmm.
the standard rate is 68. So, you have to do 68 into 7,000. 476,000.
Hmm.
Same way we have to do for direct material.
7,000 into 12.
Yeah.
Come on, do it.
And direct labor also 4 hours per unit paid at 6 per hour. So 4 into 6 into 7,000.
Whatever
160.
answer you're getting, you put in bracket, okay?
Yeah, because I have to subtract, right?
Fix overheads.
Same way, 4 into 7,000 into 2.5. Yeah, 70,000.
So when you minus, you get 154,000.
Yeah.
Now they've asked you to calculate direct material price variance, direct material usage variance, direct labor rate variance, and direct labor efficiency variance.
Okay.
Okay, we do volume and rate, right?
Yeah.
And then what do we do?
Then, so for volume, it is standard quantity minus actual quantity into standard rate.
Hmm.
And am I correct?
Hmm.
And for price, it is standard rate minus.
It is SRAQ.
हाँ, so price के लिए it is standard rate minus actual rate into actual quantity.
Hmm. So we use this normal formula.
Yeah.
Okay. Direct material price variance.
So direct material price variance will be standard rate minus actual rate into actual quantity. So 1 minute. What is the standard rate? I have to find that. Direct material is
Standard rate we had, right?
yeah, the standard rate. So I have to do three into $4 per kilo is the standard rate.
Hmm.
Okay, and for the actual rate, the information is given 82,460 using 3.1 kilos per unit.
Okay, so standard rate is 4.
Yeah,
Actual rate I don't know.
yeah,
But I have paid 82,460
yeah.
for how many units?
For 7,000. So I have to divide that.
So I have spent 11.78 per unit.
Yeah,
But now this is price and I'm writing the price per kg
yeah. So you have to divide that more.
divided by how much? Per unit I'm using
3.1.
3.1.
Yeah,
So actual rate is how much?
3.8.
3.1,
How 3.1?
3.8.
Yeah.
No, actual quantity.
Actual quantity, the one that we calculate above that only we'll write, na?
So 3.1 kilo per unit.
Yeah,
Into how many units?
7,000. 21,700.
So actual quantity is 21,700.
Miss, I have a question.
Ask.
Miss, so above what information we found that is useless to this?
That is just telling us that we planned for 176,000. This should be a standard profit, but our actual profit is less. These are
Oh,
the reasons why it is so.
okay, fine. Hmm,
That's just that.
okay,
Nothing is useless.
okay.
Okay, now you expected to pay 4 per kg,
Yeah,
but you paid 3.8 per kg.
yep,
So your answer would be favorable.
favorable.
When you multiply 21,700 into 0.2, you get 4,340.
4340 favorable.
Okay. Now direct material usage variance. You
Direct
multiply
material
by
use.
standard rate. Yeah?
Yeah.
Okay. You were supposed to use how many kgs? Your actual
Uh,
quantity is 21,700 kg, right?
yeah.
So you were supposed to use how many kgs?
1 second, you have to multiply. You have to do the 3 kilos per unit, so 3 into 8,000.
No. This is standard quantity for actual production. Always for actual production, you should be knowing it.
Okay.
You compare the flex with actual. So you were supposed to use 3 kgs
Yeah.
for how many units?
For 8,000 units.
Actual production is 7,000
7,000.
units. So you were supposed to use 21,000 kg, but you used 21,700 kg. Your answer is adverse.
Oh, yeah.
Okay?
Yeah, okay.
Standard rate is what?
4.
2,800.
Okay.
Got it?
Yeah. But it's adverse.
Hmm.
Hmm. Direct labor rate now we have to do.
Rate, na?
Yeah, so it'll be standard rate minus actual rate into actual quantity.
Hmm. What is standard rate?
Standard rate is 6 because
Actual
it's
rate?
actual rate is 5.80.
Actual quantity?
Actual quantity is 1 second. Same we have to do for this also. 182 700 divided by 7,000.
And also 5.8.
Yeah, into 5.8. 4.5.
This is wrong.
But Miss 182 700 divided by 7,000, that part is correct now.
Okay, I'm finding actual quantity.
Yeah.
So I have to find actual quantity for
First you have to find per unit.
1 minute. So 182 700
Yeah.
I am paying for at the rate of 5.80. That's it.
Oh. 31,465.517.
It's approximately 31,500.
Yeah.
Yeah,
Yeah.
you were supposed to pay 6.
But we paid less, so it's favorable.
Efficiency variance.
Efficiency is standard quantity minus actual quantity into standard rate.
What is the standard rate?
Standard rate is 6.
Actual quantity that I've used is
31,500.
standard quantity,
That I don't know yet. I have to
4
do.
hours.
Yeah, 4 into 7. No, sorry,
Yes,
4 into 7,000, right?
yes.
Yeah.
For actual production, okay?
Yeah.
I was supposed to use how many hours?
You were supposed to use 28,000.
How many hours I ended up using?
31,500. So it's adverse.
Okay.
Yeah.
Actual fixed overheads for the month was 28,000.
78,000.
My fixed overhead as per master budget was how much? 80.
Yeah, 80.
As per flex budget was
70.
70. And actually I spent how much?
78.
78,000. I plan to produce how many units?
8,000.
I produced how many units?
7,000.
Fixed overheads are absorbed on the basis of direct labor hours.
Yeah.
What was my direct labor hours for the flex budget?
For the flex budget, the direct labor hours were 168,000.
Sorry, how
One six
160 hours
because
I'm talking. 4
yeah,
into
we did.
7,
Oh, like that.
28,000 hours.
Yeah, sorry, I had
And actually I use how many hours?
31,500.
31,500 hours. And
Yeah.
fixed overheads are absorbed on the basis of
Of
direct labor hours. I told you, right?
yeah.
Keeping all this information in mind, okay, they are telling us something. Actual fixed overheads is how much?
78,000.
Fixed overhead expenditure variance was 2,000 favorable.
Huh.
Fixed overhead volume variance was
10,000 adverse.
explained by fixed overhead volume variance was adverse. Your answer should consider subvariances of the fixed overhead volume variance, but calculation is not required. Okay, I want you to think and tell me why the volume variance was adverse. Think what is
Uh,
volume variance. Think about the meaning of volume variance. I'll give you 3 minutes to think, and then
okay.
I will come back. The main answer for this I have put in your worksheet, the dot style worksheet. Okay.
हाँ.
Now let's talk about what is fixed overheads volume variance. Fixed overheads volume means the quantity, right?
Yeah.
And fixed overhead quantity means it is directly related to direct labor hours.
Hmm.
Your volume variance is adverse, isn't it adverse?
Yeah.
Adverse means you planned to use something less and you ended up using more. Yeah.
Yeah.
But what is fixed overhead? Fixed overhead is something that is going to be spent irrespective of the number of units.
Okay.
If I produce less units, then the fixed overhead per unit would be more.
Yeah.
Why? Because the fixed overhead will be spread over few units. Yes.
Yeah.
If I have to irrespectively spend say 100,000, and in this 100,000 I am only teaching 10 students, I have to pay rent 100,000. And this 100,000 I have to teach 10 students. So every student I will allocate a portion of rent. How much? 10,000.
Yeah.
Okay. So this is my fixed overheads that I have to incur. If I have only 10 students, my fixed overhead that I would allocate per student would be 10,000. Yeah.
Okay. Yeah.
But if I have 20 students, so per student will be charged how much for the fixed overhead?
5. मतलब
5,000.
yeah.
Fixed overhead is 100,000 only. But now instead of 10, I have 20 students. So per student charge would be how much?
5,000.
5,000. So when I say I have fixed overhead volume variance negative, that means I am producing less number of units, and because of that I cannot spread my fixed overhead over those units.
Yeah, makes sense.
What did I say? When I say I have fixed overheads negative, adverse,
हाँ.
that means the output that I am producing, it is less than planned.
Yeah.
Because this output is less than planned, that is why what is happening? My fixed cost is spread over few units.
Yeah.
If my fixed cost is spread over few units, what does that mean? It means that the cost per unit is
Will,
higher than expected.
yeah, but it will reduce now then. But
Because I am producing less units.
oh yeah, okay, हाँ.
Okay, that is the reason the cost per unit is higher than expected, and that is why I have fixed overhead volume variance, because my volume is less than expected.
Okay.
This is what you have to understand, that because the volume is less than expected, your fixed overhead is spread to few units.
हाँ.
Okay, because it is spread to few units, what is happening?
What is happening as in like
The fixed cost per unit is increasing
yeah,
because the volume is less,
yeah.
volume of output is less.
Hmm.
Because the volume of output is less, the fixed cost per unit is increasing, and that is the reason why you have fixed overhead volume variance. First, you understand this.
Yeah, okay.
Fixed overhead volume variance will always be adverse if your volume of output is less.
हाँ.
This is your key point. What did I say?
Fixed overhead volume variance will always be adverse
When
when your output is decreasing.
the volume of output is less.
Yeah,
Why?
because then the fixed cost per unit will increase, na?
Then the fixed cost per unit will increase. Now
Yeah.
the question is asking why fixed overhead volume variance is adverse. This is my question.
Yeah, so then the
Why
answer
fixed
is
overhead volume variance is adverse?
okay.
Tell.
So first will be because the volume of the output is less, so the lower
The
production.
lower production level, you produce less number of units than the budgeted. You budgeted to produce 8,000 units, but you actually produce how many units?
You budgeted to produce 30.
8,000. You produce 7,000.
Yeah.
Okay. Second thing is inefficient use of capacity.
Okay.
Now, what is happening? You were to produce how many units?
You want to
You were to
produce
produce
8,000.
8,000 units. And to produce this 8,000 units, you were supposed to take how many hours? 32,000 hours.
Oh yeah, huh.
4 hours per unit.
Hmm.
What did you do?
You produce 7,000 units,
You produced 7,000 units and you took how many hours?
31,500. We calculated that, no?
31,500.
Hmm.
So that means your fixed overheads was paid for 32,000 hours,
Yeah.
but you used 31,500 hours.
Yeah.
You are inefficiently using your capacity.
Okay.
And you produce less number of units, fine. Okay, that is to there only.
Yeah.
But apart from that, you could have used 32,000 hours, but you did not use 32,000 hours.
Yeah.
See, first thing to you have underproduction. Okay, now fixed overheads is fixed irrespective of the quantity that you produce. Yeah,
Yeah.
you were supposed to use 8,000 into 32,000 hours, and that is the way you decided that your fixed overhead would be charged at 2.5 per hour.
Yeah.
How you calculate OAR? Budgeted overheads divided by budgeted activity level.
Yeah.
So your budgeted overheads was how much? 80,000.
Huh.
Budgeted activity level was 8,000 into 4. 32,000 unit, 32,000 hours.
Correct.
So what is your OAR?
1 second, I will tell you.
80,000 divided by 32,000. Your OAR is 2.5 per hour. Per direct labor hour. Yeah?
Yeah.
This is the way you calculated this 2.5.
Huh.
Okay? Now that means you had to use 32,000 hours.
Okay.
You had to use 32,000 hours, and that is why you were paying 80,000.
Yeah.
Digest this fact. Your volume variance is negative.
Huh.
Two reasons. One is underproduction, you produce less. Second is less utilization of your capacity.
Okay.
First reason is what? Underproduction.
Yeah, this underproduction I got.
You got the underproduction. And second subvariance of the fixed overhead is fixed overhead capacity variance. What is fixed overhead capacity variance? Your factory actually had the capacity of using 32,000 hours because you were to produce 8,000 units.
Yeah,
You were to take 4 hours per unit.
yeah.
So your budgeted activity level was 32,000 hours.
Hmm.
For this 32,000 hours, you had paid a fixed overhead of 80,000. Yeah, 80,000.
Yeah, yeah, yeah.
How did you get this 80,000? You actually calculated your OAR as budgeted overheads divided by budgeted activity level. Budgeted overheads 80,000, budgeted activity level 32,000 hours. So OAR was 2.5.
2.5, yeah.
OAR was 2.5.
Huh.
They gave us the 2.5 and they asked us to calculate this. Now I'll come back again to fixed overhead capacity variance. It is a subvariance of fixed overheads. So your actual factory capacity was how much?
So the actual factory capacity was 8,000.
For 8,000 units, you had to spend 4 hours per unit. Your
Yeah,
actual factory capacity was 32,000 hours.
got it.
Okay. But what did you do? First, you produce less number of units. That too you did only. Yeah.
Yeah.
Apart from that, you used less hours also. You did underutilization of capacity.
Huh.
What did you do?
Underutilization of capacity.
What is underutilization of capacity? You had paid 80,000 thinking that you will use 32,000 hours, but you actually used how much?
You used 31.
31,500 hours.
Yeah,
So you did underutilization of capacity. So this was another reason, second reason why your fixed overhead volume variance was adverse.
yeah.
Okay, now I'm giving you sub variances of fixed overhead.
Variances.
Of fixed overhead. There are two sub variances of fixed overheads.
Oh, like the volume and expenditure that way.
Okay, first is the fixed overhead variance. One is fixed overhead volume variance, and one is fixed overhead expenditure variance. Are you
Yeah,
with me? Now
yeah.
there is a sub variance of fixed overhead volume variance also. There is sub variance of fixed overhead volume variance. First is fixed overhead capacity variance. This is what they exactly want from you. What do they want from you? They want you to mention about the sub variances of fixed overheads. So first sub variance of fixed overhead is fixed overhead capacity variance. Are you with me?
Yeah.
What is the meaning of fixed overhead capacity variance?
To see how much capacity there is, like if
Okay. So
uh,
in this question, your actual capacity was how much?
32,000.
Your no, your budgeted capacity. And your actual capacity is how much?
31,500.
That means you did underutilization of capacity.
Yeah.
Because you did underutilization of capacity, what happened?
Because you did underutilization of capacity, it was adverse.
Your volume variance became adverse.
Yeah.
Okay. Next subvariance of the volume variance is fixed overhead efficiency variance. You need to learn this. I'll give you time to learn.
Okay.
Okay. Now understand very carefully. You were supposed to use 32,000 hours to make how many units?
To make 8,000.
You were supposed to use 32,000 hours to make how many units you said?
8,000.
Okay, to make 8,000 units. But you actually used how many hours?
You use 31,500 hours to make 7,000.
What is the implication of this?
That uh, you made 1,000 less in only 500 less hours. Like, understood? Like that.
Yeah. So, what is your efficiency?
Bad. Inefficient.
You are inefficient. I'm not talking about you, but I'm talking about the.
Yeah. Yeah.
Now, how will you put this in words?
In words, how will you put it? Like, the
Okay,
business was inefficient as they
make
took.
8,000 units. 1 minute, wait. Huh?
uh,
But you used 31,500 hours
yeah.
to make 7,000 units.
uh,
And actually, to make these 7,000 units, you should have used how much?
1 second, cross multiply I have to do now.
Array, 4 hours is the standard hour, right?
Oh yeah, okay, 21,000.
You should have used 28,000 hours.
Yeah.
That means your efficiency is also bad. You used how many hours more? You used 3,000.
500.
You used 3,500 hours more
Yeah.
than the expected.
uh,
So this is fixed overheads efficiency variance. Okay,
yeah.
let's just sum this up. Tell me what are the two variances of fixed overheads?
So one is volume and one is expenditure.
What is the sub variance of volume?
Efficiency.
Hmm?
And what was the other one? Usage. What I forgot.
Fixed overhead efficiency variance, and the other one is fixed overheads capacity variance.
Yeah, capacity.
What is capacity variance?
OAR you have to find out.
Okay, what does capacity variance tell you?
It tells you if you're
You
making.
could use factory for X hours.
Yeah.
You used it for Y hours.
Yeah.
It could be less or more.
Hmm.
If you use for less hours, then it will be
Favorable.
you underutilize your capacity.
Oh yeah, sorry. So adverse.
If you use more hours, then
Favorable.
favorable because then you will have more units to spread your fixed overheads to.
Yeah.
Fixed overhead efficiency variance. In this, what you do, you take your standard hours
Huh.
for actual production.
Okay.
This you will compare with actual hours for actual production.
Huh.
Our example, our standard hour was 4 per hour per unit and actual production was 7,000. So we should have used 28,000 hours. Yeah,
Yeah.
but we used 31,500 hours. Yeah,
Yeah.
so your efficiency is bad. You're using more hours. This is just like the direct labor volume variance. Now I want you to go back to the MS and try understanding why the fixed overhead volume variance was adverse. Come on, first reason why it was adverse was dear first reason why it was adverse was what?
The fixed overhead volume variance was adverse because actual production was less than budgeted production.
Okay, then
The,
subvariance is
the fixed overhead capacity variance was adverse because actual hours worked were less than the hours from the fixed budget as
what is
31,500.
capacity variance?
Yeah.
What is capacity variance?
Oh, when you use the factory for X, when you're not supposed to use the factory for X hours, but you use for Y hours.
So you were supposed to use for 32,000 but use for 31,500.
Yeah.
And efficiency variance is just like direct labor volume variance.
Yeah.
Okay. Okay, here we are done. Now we go to the D part. What does the D part tell you?
Okay.
This was important because it was a new concept.
Uh,
Come on, D part.
Analyze the directors whether or not the company should start to prepare budgets for both trade receivables and trade payables. Justify your answer.
Okay, the company is already making sales, production, purchase, and labor budget. Should they
Yeah.
make trade receivable and trade payable budget? Yes and no. What is
Yeah.
the points in favor?
Okay, so it can help predict cash inflow and outflow, which can help make cash budget.
Okay. It
Helps in
helps you to
future
prepare
controlling.
flex budget. It acts as a benchmark.
Yeah, future managing helps in giving employees targeted budgets.
This is your favorite. Now give the point
Yeah.
against.
Okay, now disadvantage I say.
Huh.
Yeah, so disadvantage is that they, even if they make the budget, they don't have enough money to pay on time.
Okay. It is expensive, time consuming, increase the administrative cost, and it is not going to regulate your suppliers or customers.
Yeah,
Okay. So, what is your decision? It is
they should
always
make.
good to be organized.
Yeah, that's my decision. They should make.
So, this we complete 9706, paper 42, Feb March 2024. Please memorize the sub-variances of fixed overhead volume variance,
Ah,
capacity efficiency.
okay.